Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome to the Wealth Without Wall Street podcast. And Russ, we're in for a ridiculous amount of education today.
We're getting deep into something that we all like, some of us even wear, and we would all like to have more of.
What's that?
Gold.
Gold. There's gold in them there hills, Russ.
See, I wanted to play Up on Cripple Creek, and then you said, no, that's going to be lame. But yeah, you turned around and did that.
Well, I mean, come on. Everybody has this idea of a gold rush, right? There's all kind of different things we're running after these days as the new gold rush, but we're going to the original gold rush.
Well, I will say, sidebar story, last summer I was in Colorado Springs and I went into a gold mine.
Okay.
It was actually in Cripple Creek, the song by the band, Up on Cripple Creek, yes. So you got a chance to go down into the mine. You got to look to see where they were actually, mining out of the granite. And I actually got a piece of like iron ore that if I wanted to heat up to, 3,000 degrees, I could have tried to melt it down. Which, by the way, I mean, sidebar, like who in the world ever figured that out, that you could like have to heat something up to like 3,000 degrees and like, maybe there's going to be this shiny metal that other people will want in here.
Yeah, that is a random thing. But today, we're actually going to learn from a super expert. If you're relying on Russ and I for advice about gold, how much you should buy, if you should buy any, what would happen if the fiat currency went away? I mean, a lot of people we're talking to on a daily basis, they have these questions, these fears, like, I mean, what would happen in that event? And Peter Hugg is our guest today from Kitco Metals. He is going to share ridiculous insights and practical ideas of what would happen in that situation.
Well, yeah, I think that we all probably have a little bit of question to how much gold or precious metals should I have? Because we've all thought of, what if the dollar goes away? And that is addressed in this episode, which I was actually pretty interested in his answer, because we've heard other economists tell us what they think is appropriate amount of gold. But from somebody who's been in it for like 40 years, I mean, the gold rush as it relates to price value in the last 100 years, it all happened in the late 70s, early 80s. And Peter Hugg was at he was right there. He was working in that marketplace when it happened. So he's got a pretty good reputation and some insight. So we've been asked about gold. We've been asked about, should this be something we should put our money in? So we went out and got an expert in the subject matter. You're going to get to hear from Peter today. Let's jump onto it with Peter.
Welcome into the show, Peter. We all of a sudden sound and feel inferior. I'll go ahead and tell you.
It's a pleasure to be here, Joey.
Wait, is that because his name is so simple, Joey? His name is simple, H-U-G, Hugg.
And I had to ask him how to say it.
Well, that's all right. Everybody calls Joey, by the way, Peter, Muir. His last name's Murray, but they don't get the accent grave. Now, being a Canadian, you would, naturally know that, especially. Are you in the French area of Canada?
I am currently. I grew up in Toronto, Ontario, but our offices are in Montreal, Canada. So I've had significant exposure to the French Canadian aspect of it.
Maybe I need to visit that area. Like, people would get my name right 100% of the time.
Is that considered accent grave over the E? Is that what that is, Joey?
That is, yeah. I think it is. Yeah. Not an aigu. I think it's an accent grave, yeah.
Man, that is my 2 years of French class. You're welcome, Mom.
That's I remember from high school.
I did that. All right. That won't get me anywhere except to the supermarket and back, but that's my French dictionary at hand. But that's not why we're here. We're here to talk about something really interesting, which is gold. It's a subject matter that we've touched on a little bit before when we had Austrian economist Bob Murphy on our show. And Peter, our listener is definitely interested in alternatives to the fiat currency. They're looking for alternatives to Wall Street, and everybody's asking the question: should I buy gold, and how much should I have? So we're gonna tailor our questions to you today, because you've got a long history, 40 some odd years into this world. You've seen it all. So help us understand again a little bit about where, whenever you got into the industry, where gold was and what you've seen it do, and then we'll kind of jump in some questions from there.
Oh, okay. Well, I started in the business in '73. I cut my teeth on the foreign exchange side. I was trading foreign exchange for a large global retailer at the time, and I ran their Canadian operation. And then in '76, I was hired by a bank to set up a precious metals operation in Toronto. And we developed a precious metals product. Back then, they were called precious metals certificates. I think they might even still be issued by some of the Canadian banks. And we developed a big brokerage network in Canada, and we're lucky enough to get that product on the market and be ready to offer precious metals just as the gold market took off in '79 through '80, when you had interest rates up at 18%, inflation at 16%.
Now, didn't you, Peter, tell me that was considered the gold rush?
Yeah, we called it the gold rush then. That was sort of most people look at that time frame if they're old enough to remember. Unfortunately, I'm old enough to remember.
For all three of us, huh?
and they call it, basically, it was more focused on the Hunt brothers and how they were trying to corner the silver market. Gold got a little bit of play. It moved from early '79, it was trading at about $150, and it moved up as high as about $850. And silver moved from approximately $4 an ounce all the way and touched 50 before it came back down in mid 1980 after the Fed started to reverse policy. So at that point, there were no computers. We had a bank, and we had lineups that went around the block a few times. People at the back of the line were paying people at the front of the line hundreds of dollars just to take their place in line, because by the time they got to our wickets to buy the gold or silver, the price had already gone up 20-30%. So
wow,
it was just a crazy time. Again, no computers, everything done by telephone, everything manual. There was one service provider, Reuters, which obviously is still around today, that provided markets. So it was basically everybody had two handsets on their phone, one to cover the trade, the other one to speak to the client. So it was at that time, everything seemed normal. When I look back now and consider everything being electronic, it was amazing that the volumes that we did back then we were capable of doing.
Well, and then it looked just kind of, again, everybody out there can get on Google like I am right now and looking at the history of gold, and you saw that huge spike there from '79 to the early part of '80, but then there was a pretty sharp descent. Mm-hmm. We've noticed that in some of our financial markets over time, and it seemed like pretty steady eddy until you get into like 2002, 2003, and then all of a sudden you start seeing this run up. I'm really curious as to the cause of the run up, because again, we didn't have real high interest rates. Obviously, at that point in time, there was a little bit of an increase off the low coming out of the .com bubble, but not tons. What caused it to go up, so sharply from '02 all the way up to 2011, 2012?
Well, the first part of the run up where gold made its first move from about 2000, just late 2001, let's say, to about 2006. Was a result of 9/11 and the subsequent war that was then engaged in Iraq and the Middle East. There was worries about the oil disruption. Oil prices went higher, and gold was looked at more as a safe haven type of a play and somewhere to diversify your assets in case this thing got out of hand. Everybody was scared. There was a lot of fear in the market. The whole bubble in the housing market looked weird. You could buy a house with zero down. I mean, everything started to look very inflationary. You had a housing bubble that was moving considerably, much more aggressively than it is today. because of the leniency of the lending and obviously the fraud that was involved in a lot of these deals. So there was this perception of inflation starting to take off in a big way, plus the fear of what was going on in the world that started that first little jump up in gold. And then you had the financial collapse that occurred in 2008, and that really scared everyone. Everybody felt that we were going into a Great Depression.
Oh, yeah.
To the 29 scenario. And gold then got its second round of legs, helped by the Federal Reserve, which at that time just pumped massive amounts of liquidity into the market, not only the Fed, but also the European central banks, the Japanese central banks. Pretty much every central bank around the world just massively produced liquidity into the market, drove interest rates to zero, and that perspective also created a weaker dollar as U.S. rates plummeted much quicker than European rates. So money flowed out of the dollar into the European currencies. A weaker dollar was also perceived as inflationary, and that fed on the hype and the fear, and then gold took off, and it was basically just sort of fed on itself and ramped up from 2008 until it hit a high of $1,920, roughly $25 in 2011.
Yeah, no, you see that huge spike, but then very, very similar to the market, we see kind of a pretty straight descent from that point, and then it's been kind of steady again for the last probably 2-3 years. So for our listener who's sitting there deciding, okay, do I buy gold? What would be the purpose for me of having it? Kind of speak, obviously. Joey and I, we're going to pretend that we're dumb in this scenario, okay? Just as if we really understand these questions, but we want to ask the question that we know the person listening to this is asking, and that's what do I do with gold? What's my big end to using it? What do you say to a guy like that? You obviously maybe you're riding on a way home and somebody sits next to you and say, "What do you do?" And you start talking about gold. So you're clearly got to bring it down to elementary level. Tell me what did you talk about?
Well, I mean, assuming we got on the bus together and you asked me the question tonight, I mean, I wouldn't answer the question without asking you a question back, and that question would be, what's your motivation for buying gold? Like, what are you trying to achieve with the purchase of gold?
That's huge. Now, I'm going to answer that for you in light of how I feel like we get this question all the time, Peter, from clients. They already are at a point with their cash. Like, okay, we've got the infinite banking concept. We're managing our cash through these life insurance contracts. I feel really comfortable with that. It's a great place for us to store that. But there's still some concern. Okay. Like, well, what happens if all these doom and gloom conversations really come to fruition? Should I have gold? How much? In what denomination? And I don't want to hit you with all three of those at once, but bring it to me practically. At what level should I own gold, and for what? In light of some fear, maybe.
Okay, so if you look at gold from the perspective as possibly providing, and again, I'll use a word that is very common in the industry when people speak or analysts speak about, holding gold in your portfolio, they tend to use the word insurance with that investment. So if we look at it from that perspective, where you're going to be holding a portion of your portfolio, the percentage to be determined in a minute, but a percentage of your portfolio in gold, and you are looking for that percentage basically to act as an insurance lever should something go wrong in the financial system or whatever. It could just be a stock market correction of 30-40%. It could be a number of things that create an imbalance in your portfolio, and you want some protection against that. Or it could be a geopolitical event that will hit the stock market. If there's a war declared against North Korea or Iran, the stock market will drop. You want some protection against that just to sort of balance out your portfolio risk. If that is your motivation, you'll get sort of a pat answer from a lot of the analysts out there. They'll say, hold 10% of your portfolio in gold.
We've heard that before.
They'll put a period behind that sentence and they'll walk away. It's
Right.
an incomplete sentence. Gold is not the where-all, be-all. I mean, gold is a commodity, and if you are going to hold gold as your sort of insurance investment within your portfolio, it's still an investment. You don't just buy it and forget about it. You need to calibrate your portfolio constantly. You know, whether you do it every quarter, every 6 months, or every year, you look at your portfolio, and any portfolio advisor will tell you it'll depend on your age, your risk tolerance. You'll make changes within your portfolio. You'll rebalance your portfolio. But let's assume you go in with the concept that you want to hold 10% of gold in your portfolio as a security hedge. Now, if you had bought gold in, I don't know, pick a day, 2008, 2007, when gold was trading south of $800, and then in 2011, it's at $1,900, and you had done absolutely nothing, which is not what I'm saying you should do. You should look at it every 6 months. But the percentage of your gold now would not represent 10%. My guess is it would probably represent 18 to 20% because of the jump in the gold price. What you need to do, if you were truly holding gold as an insurance position, is you need to liquidate the 7 or 8% that you're over of your 10% barrier and bring your gold holdings back to 10% of your portfolio. Vice versa, when gold was at 1,900 and you got caught up in the hype, there were analysts out there saying this is it, it's over, gold's going to $5,000, $10,000 an ounce, and you bought it at 1,900, and then a year later, gold was sitting down at 1,500. You again weren't holding 10% of your portfolio in gold. You might have been holding 6%, at which point you have to buy 4%. So what that'll do is it'll keep your 10% insurance position in line all the time, but it'll allow you to enter the market on weakness and sell excess gold on strength.
Well, that's a great just takeaway, just something practical for people to be looking at that and reviewing it every 6 months and kind of calibrating, like you said. Let me throw another kind of question in there. How, in the event that something were to go terribly wrong and the dollar were to fail, okay, and somebody is sitting on gold, in what type of gold? And I'm going to ask a dumb question because I don't know all these answers, but there's certificates, there's bullion, there's numerous ways people can own gold. But in the event that they need it for a catastrophe situation, how would you advise somebody to have owned that gold
and held it? Yeah.
And
all right. If you use the word catastrophic or Armageddon,
right,
and you are implying with those words that the U.S. dollar will literally be worthless and the U.S. financial system will have collapsed, I can tell you that would not be an isolated event. The entire financial system of the world would be in the same boat. I mean, the U.S. financial system will not collapse independent of bringing down every other financial system in the world, maybe not the Chinese and maybe not the Russian. So think of it in the sense that you are now in the continental United States, and let's assume Canada suffers the same fate, which it will if the U.S. economy implodes to the degree that we're talking about here.
Right.
What is it likely you're going to need? I'm pretty sure you're going to need a gun. And you're probably going to need ammunition.
Check.
Yeah, you're probably going to need a place some kind of shelter.
I'm going to Russ's house.
Okay.
Check.
You're probably going to need some kind of energy, gasoline, generator, something. You're going to need something to create a living condition, especially if you're not living in Florida, and you're going to need food. So let's assume I come and knock on your door and I say, buddy, have you got any food or gasoline? You'd say, yeah, I might. What do you got? I said, well, I got a gold bar. Do you honestly think you would take the gold bar and give me your gasoline?
Nah, not a chance.
I mean, gold in that context.
How big is the bar again?
In an Armageddon context, gold would have no value.
That's actually a really great point there, Peter, because sometimes you hear that. You say the conspiracy theorist, the one who says Armageddon's going to happen, the fiat currency is going away, and that's why I'm holding gold. I've never heard anybody describe it in that example. That really is interesting that, yeah, I'm not going to trade ham sandwich for a gold bar. I'm not going to give you access to my propane tank, which is going to be running my generator inside of my compound, which I'm going to be guarding with plenty of guns, Joey, just so you know. I'm not. Yeah,
Dang, that's kind of aggressive, right there, Russ. I mean, I thought we were friends.
Well, you're an eater, bro. I've seen you eat. Like, I mean, I'll let your girls in the house, but bro, food's gonna get quickly. I'd have to ration you. Yeah, this thing would get ugly. I'm sort of thinking of like the movie Alive. I mean, this thing's just not going to go well. So, but
let me give you another context though, where we don't have Armageddon, but we have a context where, for some reason, if something goes wrong, it doesn't matter which country you're in. It could be Canada, U.S., could be pick a country. It doesn't matter. When something goes wrong in the financial system that's generated, usually, let's say it's localized. Pick Argentina, for example. First thing the government will do when they perceive that there is going to be an issue, they're going to prevent capital flight. They'll impose capital controls and not allow you to send your money out of the country. So then you're saying, okay, so now gold maybe does have a value, because if I've got gold bars and I've got them in my pocket and I can get out of the country and I can get those gold bars out of the country with me, then I can go to another country and gold is now still trading. The financial system is still working, except your country has imposed financial controls. And there's myriads of examples in history of countries that have imposed capital flow controls when their economies have run into trouble. Now you've got an asset that you can go to another country with, sell it at market value. And in that context, if it was happening in the United States, market value would be much higher because the dollar would be depreciating and gold would be going up in dollar terms. You'd be able to sell your gold for Canadian dollars or for German or for euros, and hopefully be able to start, or at least have something to restart your life with, because your financial controls in your country have prevented you from moving assets abroad.
Okay, so in light of that, how would you have held on to that gold? What kind of form, if I'm asking the right question?
Yep. There you would want one of two types of options. One, you don't want it, if you believe that this scenario is probable, you don't know the timing, but is probable, is coming. You don't want to have the gold in the possession of anyone in the U.S. other than yourself, number one. Because if the government puts controls on, let's assume they go one step further and ban the gold ownership for Americans, which historically has already happened once in the United States. What Americans fail to realize is they go and they believe this theory, which I'm not arguing with the theory, but they go and they buy their gold from a U.S. gold dealer. I mean, the government's first place they're going to look for the records is a U.S. gold dealer, and they're going to say, who have you sold gold to over the past 10 years? And most gold dealers are going to have those records. So now the government knows you're holding gold. So if you're in that context, you want to go to a local dealer, like a coin dealer type, where they've got a sort of a brick and mortar location. Walk in, buy your gold bars, put them in your pocket, and go home. Or you buy gold bars from a foreign dealer, be it a Canadian, be it a European, and you can either store it with those dealers overseas or outside of your country, because there's no reporting requirements from either a Canadian perspective or a European perspective of any American buying gold. Gold is not a reportable transaction currently. Now, it may change, but currently it is not. So you could store your gold outside of the country. Then basically all you've got to do is get your body out of the country, go to your gold, pick it up, and you've got your gold. If you're going to buy the gold personally and you want to hold it, and it's possible you might need this for international liquidity, then you need to be careful what type of gold you buy. And just to give you an example, I mean, the American Eagle gold coin, pretty coin, nice coin, but it's one of the worst coins to buy if you're looking for international liquidity. And the reason for it is it's not a pure gold coin. It's a 22 karat gold coin like the Krugerrand. So when you go to Canada, dealers are reluctant to pay you high premiums for American Eagles because they can't resell them in Canada. They're taxable. So there's no demand for gold eagles in Canada. If you go to Hong Kong, the Chinese won't touch gold eagles. They don't like 22 karat gold. They like 24 karat gold. So if you are going to buy a gold coin that has international liquidity, you would want to consider one of two. If you want to go with the American version, you would buy the American Buffalo, which is 4/9 gold, or you would buy the Canadian Maple Leaf, which is also 4/9 gold.
Okay, you just said 4/9 gold,
which is 24 karat.
Gotcha. Okay, because I would have added that up to a different number, but that helps.
Yeah, it's just in the industry, 4/9 gold is considered pure gold, 24 karat gold.
Gotcha.
Does that have anything to do with 49ers from the gold rush? I mean, I'm just trying to make a connection.
I don't think so. There's actually 5/9 gold coins made by the Royal Canadian Mint, but they don't carry any premium or anything else. 4/9 gold is the purest gold bars and coins that you can buy.
Well, and that really is helpful, because you see, again, all the movies that talk about gold and someone holding it in their possession. You typically see, whether it's American Eagles or it's these huge bars, like some sort of Mark Wahlberg, crime keeper that they keep this huge amount of gold in. So in the scenario, if one were to keep gold and we're going to keep it in their possession, is that what you typically would see? Is that somebody would have a safe that they would hold a certain percentage? How big of an advocate are you for someone holding a physical possession of gold versus keeping it in some sort of Brinks type lockbox out there?
Well, again, my mentality, only because of my past life, working trading desks, which were more orientated towards the wholesale market as opposed to retail investors. Although we, being a bank, obviously had branches, and we had a number of retail investors that bought precious metals from us. But in my context, is if I'm looking at an investment, my first criteria is liquidity and speed of being able to exit the investment. So if you've got gold bars that are sitting in your drawer, and for some reason you want to sell them quickly, sometimes you need to sell. You want to take advantage of a price. Now you've got an issue where you've got the gold bars, but the dealer, you've got to get them to the dealers, and the dealer will then get the coins, look at them, and then quote you a price. Some dealers, we allow these types of transactions. We'll lock in a price. And then verify the product once it comes in, and then pay out the client based on the quoted price, assuming the product is what it was said to be. But again, when you buy the product, unless you're picking it up from a dealer, you've got shipping and insurance. You've got to worry about it at home. You've got shipping and insurance possibly on the way back to the dealer. It's not a very liquid type of way to make an investment. If you trust your dealer, having segregated storage, and storage charges are relatively incidental. I mean, for about 0.25% per year, you can store gold. So that works out at current market, works out to about $2 per ounce per year. You can store gold. Now the dealer has your gold. Again, you've got to have comfort level with the dealer, and you pick up a phone and just say, you're holding 2 ounces of my gold. I want to sell it, and it's done immediately. So it gives you that extra liquidity. But if that's not your concern, you're not looking to trade it, you want it just to sort of have in case, then people take delivery, and I guess they put it in their home safes. I mean, the funny story I have is back in 78, I had a client in Canada that bought 1,000-ounce silver bars, which weigh about 65 pounds each. And he bought a lot of them. He bought 60,000 ounces, which was a big investment for him at the time, but it was only about $200,000 in value because silver was at $3. And about 2-3 years later, I got invited somewhere, and I met the guy, and he said, "Look, I'm having this barbecue on the weekend. Do you want to come by?" And I said, "Yeah, sure, I'm not doing it." I showed up, the guy's barbecue, and we're out in this patio, and there's a bunch of people, and he says, "How do you like my paver stones?" And I said, "Yeah, look okay to me." And he said, "Yeah, well, it's all silver bars." All he did was he took them and he painted them over. and there was no way you could tell. It looked like paver stickers. But he had 50,000 ounces of silver sitting in his patio that people were sitting on and walking on. I mean, it was just a weird thing. I mean, people sometimes do strange things.
That is amazing.
Yeah, they say the streets of heaven are paved gold. I guess his was a different version.
Well, I can imagine when he was selling the house saying, look, I'm going to sell you the house, but it doesn't come with the patio.
Yeah, I mean, I've heard of people like taking the mirrors off the wall, whatever they leave, but they uprooting the patio. My wife's out there.
A lot of people, I guess, I used to do a lot of business with a company that I'm sure you've heard the name. I'm hoping he's still alive. I think he may be, a guy called Howard Ruff out of Utah. And he was a big precious metals newsletter writer back in the day in the 80s. And he had a huge following. And, he strongly urged people to build bunkers and to have 6 months of food and to have 20% of their assets in gold. And I tell you, there are certain parts of Utah where a lot of these homes still have their bunkers. And these people have their guns and their bunkers and their food supplies and their energy supplies and their gold. And, they store it and protect it in whichever way they find appropriate. And I'm sure they've all come up with novel ways of holding their precious metals. Some as blasé as putting them in a jar and putting them in the fridge, and some as intricate as turning silver bars into patio stones.
Well, Peter, this has been a heck of a turn of events in our podcast. We've kind of run the gamut on gold, and it's great to just kind of expose again the person who's listening right now who's trying to figure out. Yeah, I mean, the fiat currency that exists, there's not a whole lot of confidence in it, but at the end of the day, there's a use for gold, but it may not be, as we know, the concept, unless we're going to be, taken over like, the East Indies was from Japan, and we're trying to get, smuggle gold out of there. So that's our wealth that we're going to transfer out of the country. And depending on, I guess, where you're listening to this, maybe you're in a country or area that is possible. But as we sit here in America, that's not something that's on my radar. I do worry about my kids in school systems, but not necessarily as being taken over by another country. I just think it's really cool to have you share just some insight. So if somebody wanted to look up more about gold and read some of your great, insightful articles, where would you have them look?
Again, as I mentioned prior to the show, trying to be as transparent as possible. And not because I work for Kitco, but I do find the company unique in the marketplace in the sense that our website, kitco.com, is really a place where somebody that hasn't invested in gold or wants more information on gold or wants to understand where the trends are going, it really is a place where you can go and get honest information. You might not like what you read. And there may be, analysts out there that are very bearish to the market, and you happen to be a bull, or you may be a bull and or bearish the market, and somebody is saying, look, you got to buy at these levels. But what it does is it gives really detailed information from some of the best minds in the industry as to where they see the price of gold going, and they also give commentaries and insights as to what the best vehicles are for holding and buying or selling precious metals. And I think any investor, whether they buy gold or Apple shares or life annuity products or second mortgages, whatever you're investing in, you should take the time to at least understand what you're buying. And the Kitco.com website at least gives you that information. If you want to then make a decision and trade with Kitco, we have a variety of options. You can do that through us, but you can certainly go to any dealer you feel comfortable with. But it is a site that does give you a lot of information, which will help educate you, so at least you can make a more informed decision when you do decide to pull the trigger.
Yeah. Well, Peter, that is, you have shared a ton of great insight, added a lot of value to it. Really, it should be a pretty simple topic, gold, but there is so much complexity and so much confusion. And I feel like you've helped us today to just kind of weed through that and give us a framework of what's your motivation, and then kind of giving us some real world life examples of what could happen. I'm just very grateful to have had your experience and expertise on our show. Now you're answering their questions, and I don't have to have that answer anymore. So I'll be able to share this with them for years. So thank you so much for being on, and we truly, truly appreciate it.
It was my pleasure. Thank you very much, guys.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.